For those serious about becoming successful, consistently profitable options traders, now is the time to build skills in technical analysis, market analysis, and applied volatility to get those results. We have multiple memberships, starting with our Go membership that teaches rules-based trading and our Pro membership that teaches more subjective trading. For more information, go to lockeinyoursuccess.com/memberships.
Hello, everyone. Welcome to our special Pro Membership Open House Week. It is January 22nd right now. I'm here and I'm off and on with Stephen, and Stephen also happens to be here. Hello, Stephen.
Hey, John. How are you?
I'm awesome. How about yourself?
Doing great.
Awesome. So, first of all, we'd both like to welcome everybody here to, or our Go members who are able to apply for this. We have this for Go members who've been members for 3 consecutive months, usually about once a quarter. And it's just to give you an idea of the different way we approach the market and see things as a Pro member versus a Go member, and I believe you'll find it very enlightening. Let's kind of get into this a little bit. I just want you to think about, what is your approach to learning how to profitably trade with a trading strategy, right? So the amateur approach, which is also the initial, and I will call it the learning approach to complex options, is where we focus on things like creating trade rules that won in the past and backtester, right? So I'm trying to create these rules, and basically, I won't say all the time, but 80% of the time, 90% of the time, it's like virtually all the time in backtester. That tends to be the focus, focusing on backtesting results or past results, trying to get the most intricate possible understanding you can possibly get of all the options Greeks and the second order Greeks and all that other stuff. Focusing on neutralizing delta, maximizing theta, neutralizing vega, those types of things, right? Trade alerts. That is the way that all of us, or most of us, tend to go through. I think there's value in spending some time there, but it should not be your end game, right? Taking that information and just trying to apply that to the market. Once we get that down, we should be looking at more of a professional approach, and that's going to involve understanding typical price movement patterns and exploiting them. Or at the very least, if you can't exploit them, avoid being positioned in ways that's going to be hurt by them, right? A lot of our traditional income trades work in the manner where if we get a market down move, the position draws down. And that's okay, because your position is going to draw down somehow. Either going to draw down with an up move or a down move, or it's going to be a volatility thing, right? Something's going to draw you down. But the typical income position, when you think about it, market goes down, position draws down, we attempt to flatten delta. A lot of times that includes a size increase. Not all the time, but a lot of times that'll include some sort of a size increase, going flat delta, and a lot of times that also involves adding risk to the upside if the market reverses. If you think about your trading strategy, it probably does that. Most of our completely non-subjective rules-based systems will do that. And again, there's nothing wrong with that strategy. I mean, if you want to be mildly profitable, trade blind. Like I said, you could probably be mildly profitable over time that way, so long as you keep your position size okay and you don't get into a certain situation where the market movement tends to change, the normal behavior of the market tends to change, and you get caught off by that. And Stephen, feel free to jump in on any of that if you have any comments or anything.
Yeah, no, I do have a quick comment that it's a delicate thing to go through that process, which I agree is necessary, but not get married to it. Going through the process that you listed before, maybe you've got a strategy and you back test it, and yeah, I mean it's a step. It's not a lifestyle. It's not a trading lifestyle, as it were, and that's where you want to be able to say, this is just a necessary step to get where I really want to go, where I can exploit what's happening in the market. I get asymmetrical risk reward situation. So that's what people don't understand. this is where you spend some of your time. You want to spend the bulk of your time, if this is your goal, to be this kind of trader, subjective trader, in what we're going to talk about moving forward. So I don't want anybody to feel like this is, not worth their time to go through. You definitely want to see how positions behave, and the light bulb will start to go off more as you move into using these strategies in a subjective manner. So just want to make that comment.
Right. And I agree with all that. So, moving forward, right? So one of the things I tend to focus on more than other things, and if you've been with me for a while, or certainly if you've been to the advanced programs, you understand this, right? I like to focus on what is normal market behavior. These are just examples of up moves that we've had, mostly after down moves, except for this one. This was after a consolidation move. But 180 points up in 36 days, 300 points up in 10 days, 300 points up in 10 days, 220 points up in 10 days, 500 points up in 12 days, right? And most of these larger moves to the upside come after the down moves, right? So we happen to enter our strategy here and we get pushed back. Usually when your strategy gets pushed back, it gets drawn down money. A lot of the typical styles are flat and delta. Then we're drawing down money, and then we have to try to make money in this being flat delta, right? 320 points in 4 days, 250 points in 13 days, 320 points in 7 days, 220 points in 4 days. If you understand this pattern, and this is normal, I can go back and I've been doing this since 2006, this type of analysis. I can go back to now that the point values are different in 2013, but it's the same pattern, right? The point values are different in 2020. It's the same pattern. The point the differences are in a downtrending year, but it's the same pattern, right? The pattern's the same. This is like normal price movement. And if you were to compare this to the Russell, it's also it's pretty similar, except it's about half. I'll get 110 points in 10 days instead of 220 points in 10 days. That's usually what the indexes run. So this is an understanding that you should have about normal price movement. Like, I'm not being like super subjective. I'm not trying to call tops and bottoms. I just know that if the price pushes down for a period of time, and if it's enough to adjust my strategy back a couple of times, then what's going to follow that typically and normally is this type of an up move. And what I'm saying is, in SPX, a move big enough to force a down adjustment in most of your normal strategies is typically, right, not rarely, not sometimes, not often, typically, right, typical, followed by an average up move about 270 points in 8 points in an average of 8 days. So when you look at that, how does your current approach to trading deal with typical price movements? And I mentioned this earlier. Typically, you get a down move. A lot of times you'll increase size. You'll try to increase theta. You'll try to flatten delta. A lot of times you'll add upside risk. So my point being is, if the market just happens to go up, a lot of times it's not a problem, right? If I enter a broken wing butterfly with very little or no upside risk here and the market goes up, that's not a problem, right? Which is a lot of our strategies are. There's some sort of a strategy that has kind of a minimal upside risk that you can kind of pull out of if the market goes up, even if there is risk there. And which is what you'll get in backtester. Like, if I backtest something, most of the time the market ends up to the upside. And anytime and where you enter this cycle, right, is completely luck dependent, because you're entering on a certain data expiration or whatever your technique is, right? You just basically you're randomly entering. If you happen to enter here, fine, no problem. But if you happen to enter here and you survive the down move and you do the adjustments in the way that's normal, you would be down a lot of money here. You'd be flat delta. You'd probably have a lot of upside risk, and then you have to go through that, right? That is what typically comes out of backtesting, though, is this strategy. Stephen and I, or the pro membership in general, are showing you a different approach to this. And you'll notice that a lot of our approaches, or if you've been with the pro membership for a while, You wonder, how does he win so often? And how do you make so much money on the risk that you're taking? And so forth. And it's because we're trading differently. We're trading in a way that recognizes what's going on here. We're trading in a way that removes structural risk to try and survive the down move responsibly. And we're waiting for the up move to happen. And you'll notice in most of the trades that we do, we're doing that. We're either positioning for the up move on entry, or and then a lot of times we will position for the up move on entry, and then a lot of the times when we get the down move, we're not like flattening delta. We're maintaining positive delta. We're putting ourselves in a position where we can wait it out and for this to go up. We talked a little bit about this in the Go meeting on Monday as well. So I think it's a theme you're going to see more and more often because it's very effective. I don't know if you have any comments on that, Stephen, or not.
No, that's great. I think it is. Actually, I do have a comment. We lose sight of just basic. This chart has got so much great information in it. Whoops, just a second.
But this is like basic, right? It's not like I'm not like diving into the scientific background of Greeks.
No. Yeah, and that's what's so simple yet elegant at the same time about this. It's markets trend, they pull back, they trend, they pull back. Trend higher. Markets made it go up, right? So I think that there is psychology out there, and it's a huge problem. I'm a bear, I'm a bull. You got to get out of that thinking. You're a trader, and you're here to make money and do that by following a process. And there are no bulls and bears out there. It's just a market. It's an auction. It's an auction market seeking a fair price. Sometimes it's higher, sometimes it's lower. Sometimes the market feels like it's found a fair price until new information comes in. And the reason I frame it that way, which a lot of professional traders do, is because that takes away bias. Let me give an example. So you get any of these down moves, if you zoom in, they can look horrendous. Oh my gosh, we're under all the moving averages. Here's the big crash, and it's all happening in social media. And the panic that people get into. And I used to be that person. I used to be, this can't keep going up, and I'm going to short every high, and I'm going to show them. You got to drop all that. Markets are made to go up. They pull back, they put in structure, they go higher. Take advantage of it. Keep it simple in your mind. This is not some battle, Star Wars battle between bulls and bears. Those just terminology that people use because they don't know any better. So, you could just look at this chart and say, if I could use a little bit of structure, get in on the lows and get long, however I want to express it, I'm going to have a high win rate and super high risk reward ratio. And to John's point, we can start out neutral. We get the pullback, puts our trade under pressure, but we can flip it into a position that gives us less risk, but more reward, asymmetric. And I just wanted to say that because I have been there. I think we all have at some point in time until we get a little bit more mature with our trading. And removing that bias is gigantic because you can talk yourself into anything. We're at the lows, and I think we're going lower. And of course, that's the low of the move. That's the swing low. It's the exact opposite. Right. But you could talk yourself into anything. But if you'll just let yourself read the market like you're reading the page out of a good book, you'll be so much better off.
Right. I agree with that completely. Sean's just asking, and this might be appropriate just at this point. Can you comment on the 2022 SPX market? I don't know if you have any thoughts on that. But.
Yeah, my thoughts are that was an excellent market to be directionally long. Your biggest point moves and fastest moves come in bear markets. I assume that's what he's alluding to, the 22.
Yeah, this pattern plays out, right? So
yeah, and you're still going to get your pullbacks are deeper. You can play short, certainly. That I'd say the difference to me is you can play both ways. I think of it with our style of trading. 22 is more two-way market, whereas 23, 24, and so far 25 is I'm going to heavily lean to the long side with my swing positions. But when you get to support, if you measure some of these moves out, they are huge up moves. And the down moves are obviously good too. So Bearish butterflies, you can scale into those.
So look at these up moves, right?
These up moves are big, yeah.
They're fast and they're huge. I don't want to, like, the same thing if we're talking about positioning. When I'm here, right? When I'm here at this low here, freaking out midday, I don't want to be positioned. And look at this magnitude, right? So the magnitude is 4063 to 300 points, basically. No, it's on 250 points in 3 days. I don't want to be in a position where I'm going to get creamed with a 250 point up move, even in the down market. Right. So I don't want to be in that position. And that's my whole point. I mean, look at the magnitude.
Yeah.
This up move, it's all the same, right? Even though we're downtrending.
Yeah. Good point. Look at your ATR goes to 100. Middle of May. I mean, that's pretty historic. So, yeah, I mean, you have to understand that you're going to get an expansion of range. And to John's point, being in a tight containment is going to get double whacked.
Right. So that process it makes it even worse in this type of a market, in my opinion. Right. So we want to make sure that we are not vulnerable to that in our positioning.
Okay. Well, let me grab the screen if you want to do that.
Yes.
And
I can
go through it pretty quickly. We'll just look at this real quick. This was on December 19th. And if you guys will remember, and we'll go to the charts, I'll set it up. But while we're here, I'll just speak to this. We had a huge sell-off, breaking out of a bit of a pattern. And I decided I wanted to get into butterflies were really cheap. $6.
You want to briefly show the price chart just so that
Yeah, I was just going to talk to this real quick and then go into the chart. Yeah. Cool. And anyway, yeah, so that's it. Entered a butterfly, but here was what was happening in the charts. So this is entry day. That's the end of the chart, or actually it's the next day, but this was the big sell-off. So just to kind of set this up, I've got two, an upper pivot and a lower pivot, kind of creating this zone, right? Market breaks out, back checks it. That was probably the setup of the year last year, at least the last part of the year in terms of A plus setup. Then we kind of have this flagging pullback. Oh, it's a little deeper than we wanted to go.
Right.
Comes into this area. So yeah, it comes in this area and busts right through it. So at this point, I'm thinking, usually when you get a breakdown move, the market is not going to V-bottom. Like it'd be really unusual for the market to sell from here and then rip back up and retake this upper pivot, right? It's going to probably try to.
But if it does, that's a good trade, right?
It is.
Just keeping in mind, right? So it's good no matter what. That's what we're saying.
Yeah, I mean, it wouldn't be my expectation, but it would certainly be MGI. So my expectation in the next few days would be, we could continue to sell off down here, but more than likely going to be range bound into this wide pivot area. So how can I take advantage of that? Let me go to the next day, which is actually when I got in. So this next day, it's certainly a down day, but it didn't really continue the momentum. So that's kind of confirming my thesis, which is, hey, maybe the market's going to try to consolidate down here. I could get in these butterflies at 30 days for less than $7, $6.65. I got tremendous range. Let me see what I can do with that. Now, I don't have an end-to-end thesis necessarily. I do know what I'll do if the market just collapses and if it starts ripping, but I'm not mapping it out into full-blown detail, right? This is a kind of a launching off point. I don't want to be in a BWB because I have too much risk down to this side. So I'm basically, the way I'm looking at this is neutral to bearish. But notice how much range I've got. I mean, this thing doesn't even draw down or max loss out until 200 points down. And I can deal with a volatility release up here if the market wants to start moving up here and or move into BWB. I mean, there's any number of things I can do, right? So you can go BWB, and then you can drop out.
Right. In addition to this, right, if you're wrong and this thing decides to bounce and it 2B reverses off of that point, like half of that candle, I mean, that's your technical exit, right? Or whatever.
Yeah.
I wasn't right with that, right? So if the thing decides to jump to like 23.20 the next day.
Yeah. Let's see, 22.80. See, 2280 puts me here, and that'd be the top of my pivot, upper pivot, right? So you're going to have, the way I would look at that is this trade probably would be drawn down $800, even though if it did, it's fine. I'm going to get a little volatility release.
Right. It would probably release volatility a little bit,
right.
and
and be fine.
And be fine. Yeah.
So let's just go to the next adjustment. And I'll show you how this kind of played out.
No, there we go. Okay.
I was wondering what was going on there.
Yeah,
so let's see what we did.
O&E's been quirky like that.
Yeah, it has. So we're starting to. Okay, wow. Okay, so let me go to the charts. Look how much time passed. This is what I want since entry. We'll just go day to day. Well, God, everything's working a little goofy. So we did sort of say range bound. We went and tested the top of the range. We can go look at that day if you guys want to. We came back down. And I didn't do anything. Actually, let's go look at the 26th.
Yeah, I was gonna say you should look at that day. Yes, yeah.
See what
Because that's when things were at their worst, right?
Yeah, that's when you can get talk yourself into doing something you don't want to do. Don't know why.
I don't know why that's doing.
Let me shut some stuff down. My computer maybe is a little stressed. I don't know. Okay, so here's the position. Did exactly what we said it could do, is test that upper pivot, and the trade's up. I'm not in trouble.
You got a nice relief of implied volatility with that bounce, and
7 days, yeah. But there's nothing for me to do. There's no reason for me to say, I don't have any information to say, I want to do this, get bullish, or start taking upside risks down. Can someone make the case for that? Absolutely. But I don't have that information. I needed to get over this area, right? 2,300.
So a different way of thinking, right? Stephen thinks it's going to be range bound. We're at the top of the range. Delta's a little hot. That's okay, right? But if I break that level, that means a huge up move. That could be my exit. I'm just out.
Mm-hmm.
Right. End of the trade. It didn't work out the way I thought. We broke range. Call it a day. And you don't have to chase it. You don't have to do something else. You might want to take a different trade or whatever.
Right.
But there's no need to freak out.
Right. Yeah, exactly. Now, if this was pressing 2,300 outside the 10, and again, I'm not really looking at Delta. Maybe I'm doing something, but for now, this is
right. You're in your range. You're under your swing low there at 2,300 or 2,280 or whatever the heck it is, and you're good to go.
Yeah. So right here is the day we're talking about. Remember, I had all this pivot mapped out before. This was a prior breakout area, retest, failure, comes to back check.
Right. This is a classic dead cat bounce.
Right.
That's where it would go. It would go down to the bottom where the bottom purple is. It would bounce to the top purple. It would come back down to the bottom. And if it's going to continue, it would break there. Right. That's normal movement.
Yeah. Test it here. Tested this one here. So that's, it's actually fitting my thesis and my structure pretty well, which is not required, but it's nice, right? And I need some new information for me to really do anything on this. In other words, a breakout here, a breakdown here, or a failed breakout here, or a failed breakout, right? So it's either going to stay in balance or stay in this range. It's going to try to break out.
We talk about during market outlook, right? So
yeah. Now this is where it gets important, right? So I can't just blindly follow technicals till we get to 0 DTE, right? Now I have to start considering, well, what's happening in the position? Well, I'm at 7 days left in the trade. I can't just continue letting this thing go. I have to start taking some kind of action to mitigate, even if I'm not getting a specific technical trigger, right? So in this case, I want to take some of the risk out to the downside, and I'm just going to play a little bit of a reverse broken wing condor. Now I'm still planning on some kind of a bounce up in this area. But if it doesn't happen, I'm taking some risk out here. And
Right. When we say positional subjectivity, this is what we mean.
Yeah. So I rolled down half the shorts as a condor order rolled down. Yeah, I just rolled them down 2. See if I get that for you guys. See if that's what I did. No, I did a little more than that. So this is that's what the order would be. I guess it'd be 2 condor orders, but in any case, this gives you an idea. Took risk out here, did not add much risk back here. Rolled the tent forward because I want to keep it close. In case I do get the bounce, I can get inside the tent a little quicker. Or if the market wants to come back down and then bounce, I'm closer to the market. I tend to like that, especially when I've only got 7 days left in the trade. Yeah. So this was the 10th. I guess I should have shown this, but on the 10th, we were pressing down into my zone, right?
Mhm.
But we were also breaking what could be interpreted as a bit of a bear flag. So that's why I made the adjustment to say, you know what? I want to stay, not bullish. I want to stay in a posture where if I get the bounce, I have some tent, but I definitely wanted to take some risk out down here. And that's why I made that adjustment. The condor order rolled down on the 10th.
Right. It looks like it was going to break down and continue.
Right. And yeah.
Short term anyway.
Prepare for that. We'll go away. Little thing. Okay. So now let me set up what my thought process was on the 13th. So on the 13th, we have a lot of things going on that gives me a lot of information. So first of all, pierced the bottom of my pivot, my zone, and reclaimed it intraday, closed above it. That's bullish. It also did a 2B reversal from this candle. You could argue whether or not it got this one, the top of the zone. It's certainly not screaming bearish. Also did the infamous, or maybe it's famous, intraday piercing of the 618 retracement and then closes above it.
That we talk about all the time. Yep.
Yeah. And then this orange moving average is the 200-day. That's pretty darn bullish signal for me. And I want to sit there and say, is there a way I can express a bet that takes advantage of that, but reduces risk to my downside and can give me something asymmetrical? Because remember, I'm getting close to expiration week now. So what can I do to take advantage of that? I'm in this posture. How about I go to this posture? And I will show you so this is what I wanted to point out to folks is risk taken completely out. So if I'm wrong, if I get back a few dollars, sure. But look what my opportunity is now, right? And if you say, well, wait a minute, you had all this opportunity, you gave all that up. One, it's a game of trade-offs. 2, if this is going to traverse to the other side, it's going here.
Right. The 2B reversal, where's it going? What's the normal up move? 3.
It's going to go to the other end of the pattern, other end of balance. Yeah. Mm-hmm. And this is going to be, could be a problem. Now, you do have this. So if the market moves kind of slow, and it doesn't necessarily blow it out to the upside, maybe you can do something with that. But, this starts falling off at 2260. No, before that, 2250.
Right.
So I'm going to have a problem at 2250. And then if it goes through it, what I would do is just start taking off verticals. Because there's no time left. There's no reason to adjust the trade. Just start ripping off the top side, the wing, taking off verticals. I'll show what that looks like to people. Let's say that you want to just keep this posture, because you could say, well, we're going to bounce inside my 10. I'm perfectly fine with that. But let's say you start to get challenged to the upside. You could just start doing, it's kind of extreme, but you could do that. If you're over here and you start getting challenged, just take off verticals. And now you're starting to take off one side, but much easier to do what I did, because you don't have to do, and there's no right or wrong. I'm just kind of showing people different ways.
Exactly. You know, when you start to understand what's going on, it's almost like it's almost hard to make the wrong decision. Right? It almost gets hard to make the wrong decision when you're not worried about making the perfect decision. When you're worried about making the perfect decision, you're always making the wrong decision. But
That's
good.
Great. Yeah. That's well said, because I tend to be a perfectionist. And somebody said one time, I heard this, they said, perfectionism in trading is inefficient. And it is so true. Because you can spend all your time modeling this up the hour before you're going to make your adjustment to find the perfect posture. Which one is better? And I still kind of get caught in that sometimes. And to John's point, you make your best assessment and go with it. I'll go forward and I'll be done with my example. But notice this is expiration. I've taken all the risk out to one side. If I lose the trade, I still make, $700, and I could probably do something if I needed to try to on that other side, depending on what the move is. We're going up. At this point, you could roll up. I left it because I felt like there was more room to run. I ended up rolling these up actually in the money, which still probably was a little bit more risk than I wanted to take. Was leaning on my technicals because this would give back decent chunk, but I still had quite a bit of upside potential just with 2 days left. But I was willing to do that. So I don't know if you had an idea of what you might do different.
Yeah. I mean, just realize what you're doing is for what it is. It's a 50-50 shot that you're going to lose half the money that you might gain, basically. And if you want to play that, that's great. Just rather than saying, I'm not betting, I'm playing probabilities, say, this is what I'm betting. I'm betting so many dollars to make so many dollars. If this happens or this doesn't happen, right, what's going to happen? And then you can kind of put some sort of a probability on that and see if it's worth, the utility is worth taking the bet or not. It's that simple, really.
It's that simple. And to your point, on this next day, I rolled the verticals up the prior day, and the next day I just said, you know what, I'm out.